From the low interest rates of 3.22% in January to a high of 6.7% last week, rising mortgage rates have substantially impacted the housing market in so many ways. The ultra low rate environment and lack of available homes, which reached record low levels in 2020 and 2021, allowed home values to escalate out of control. Mortgage rates remained at record lows for 21 straight months. So what are we seeing now? How has the rise in mortgage rates shaped our current market? If you're a homeowner looking to buy, or you just like to know your local market and stay informed, you're in the right place. Hi, my name is Brooks Marr, local realtor Orange County, and if at any point during this video you have a question, hit pause and drop a comment so I can answer that question. Now, if you want to keep it more personal, you can book a call in the description below and we'll be happy to chat. Now, let's see how rates have changed our market. In 2020, home values raised 4.3%. Then in 2021, 15.9%, and surged 22% higher through the second quarter of 2022. The median value of a detached home went from $855,000 to nearly $1.3 million. So in addition to home values increasing this year, so have mortgage rates. Upon ringing in the new year, rates were 3.22%. Then March, they surpassed 4%, April 5%, and by September, above 6%, and on September 29th, 6.7%. That's more than double the start of 2022. The combination of higher rates and higher home values has completely flipped housing on its head, and consumers have changed their approach to housing. The ultra low rate environment and lack of available homes on the market, which reached record low levels in 2020 and 2021, allowed home values to escalate out of control. Mortgage rates remained at record low levels for 21 straight months. Unfortunately, rates remained low, and the inventory dropped to unprecedented levels. Slowly, the monthly payments on a median $1.3 million price home crept up month by month. And at the end of September, with rates at 6.7%, the payment jumped to $6,969. For perspective, that's an extra $3,460 per month increase since January. There are many consequences to sky-high rates. Demand has dropped to ultra-low levels. It is 37% lower than last year, and 29% lower than the 3-year average prior to COVID. With fewer buyers in the marketplace, foot traffic is way down, open house attendance is down considerably, multiple offers are the exception and not the rule. Sales prices are normally below the asking price, and market times have increased substantially. Buyers are no longer waiving appraisals, waiving inspections, providing free rent backs to sellers, or paying substantially above asking price. The fewer buyers that remain are taking their time and very carefully approaching this market. In the end, they are absorbing a much higher monthly payment, even with buying down the mortgage rate, or going the adjustable rate route, and incorporating ways for a seller to help them buy down the rate temporarily to keep the home selling at a fair value, which is a great option as mortgage rates forecasts show rates will come down in the next 12 to 24 months. It's important that you have a plan when buying or selling a home, but if you're buying and plan to stay in the home for 10 plus years, you need to think long term when evaluating that home. The one thing that never changes in real estate is location. And if you're able to lock in a great location now that has your must-haves, there are short-term options to incorporate into a long-term plan. If you'd like to know more and create a plan for your future move, please don't hesitate to book a strategy call in the description below, and we'd be happy to assist you on that. Now, typically, in a year where mortgage rates spike higher, the inventory climbs much higher as well. As homeowners come on the market monthly, they are greeted with a muted demand. With the rising inventory and dropping demand, market times grow, and it takes much longer to sell. That was a story in 2013 when rates rose from 3.34% at the start of the year to 4.57% in September. The inventory grew from 3,163 homes in January to its peak of 6,350 homes in October. A normal peak occurs between July and August, but in years where rates substantially rise, the peak is delayed into the autumn market as there are more sellers who come on the market then. This year, as rates exploded higher, the inventory grew from 954 homes at the start of the year to a peak of 4,069 at the start of August. It stopped rising early and has dropped to 3,646 today. As a result of sky-high rates, homeowners are opting not to sell. They don't want to trade their incredibly low monthly mortgage payment, where more than 2/3 of homeowners with a mortgage are enjoying a rate at 4% or lower. Many homeowners are hunkering down and opting to stay, even if they have that itch to move. In fact, there were 784 missing for sale signs in July. The expected market time has grown from 19 days in March to 68 days today. That still puts us in a slight seller's market. The further rates surged above 5% after lingering below 3.5% for so long, the more the pool of prospective buyers evaporated. As long as the sky-high mortgage rate environment continues, expect demand to remain muted, values to slowly drop, and fewer homeowners willing to participate in today's housing market as they continue to hunker down. Now, real quick, let's go over active listings, demand, and the luxury market specifics. First, active listings. The active listing inventory increased by 8 homes, nearly unchanged. and now sits at 3,646. Yet due to mortgage rates surging higher than 5.66% at the start of September to 6.7% last week, demand continued to rapidly cool, and more sellers coming on the market. Fewer homeowners are opting to list their homes for sale due to the higher mortgage rate environment that has prevented the inventory from rising faster. The trend that developed this year is a sharp decrease in the number of homes coming on the market. Now, demand. Demand is measured by the number of new escrows over the prior month, which has decreased this month by 9%. As rates continue to soar higher, fewer and fewer buyers continue to actively pursue a home. Do not confuse this downturn in activity as a signal that this is the beginning of another large, catastrophic drop in values with a flood of foreclosures and short sales. The current market is completely different, where homeowners are coming from a position of strength. There is no panic selling, and inventories are still severely muted. Expect demand to continue to slowly fall from now to Thanksgiving, unless there's another change in the mortgage rates. With demand dropping faster than supply, the expected market time increased from 62 to 68 days in the past couple of weeks. The 3-year average prior to COVID was at 86 days, a bit longer than today. Lastly, the luxury end. In the past couple of weeks, the luxury inventory of homes priced above $2 million decreased from 804 to 797 homes, down 7 homes, or 1%. Luxury demand decreased by 23 pending sales, down 14%, now sits at 145, its lowest level since January. With demand plunging compared to the slight drop in supply, the overall expected market time for luxury homes priced above $2 million increased from 144 to 165 days, its highest reading since January of 2021. With the instability of financial markets and Wall Street and stubbornly high rates, you can expect the luxury market to continue to slow. So there you have it. That is what we are currently seeing in the Orange County housing market. Rates are high and demand is low, but that is normal for this time of year. As I said, this is nothing like 2007, so don't expect short sales and foreclosures everywhere. Homeowners are in a strengthened position from the record low rates, and competition amongst buyers is low. It's important to consider your options, as if you're looking to get into a first home or a new home, and you see one that has your ideal location and your must-haves, even if it needs some cosmetic updates, now may be the time to pursue that, as buyer competition is decreasing. It's important to create a plan, and when evaluating a home, evaluate it with the same mindset as your plan. If you don't have one and would like some assistance creating a plan, please contact us directly either through text, call, or email, or book a strategy call in the description below, and let's get that going. As always, thanks for watching, and I hope you enjoyed.